This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Welcome Toil. I'm here today with the half marathon man, the half mustache mystery, the half man, Dylan Pargiter-Green. DPG, how are you?
That is amazing. That is the half marathon, half mustache man. Is that because I can't grow hair in the middle of my moustache?
Yeah, I'm going to have to make some sort of nickname for that, mate. I heard you were running up and down mountains on the weekend.
Yep, it was mostly running, a little bit of walking, but participated in the Point of Pinnacle in Hobart on Sunday with a few thousand other people, and and now I can't sit down for fear of not being able to stand up again. So Luke and I are both standing up to record this episode.
I'm standing up because I'm trying to make an effort to be healthy. But the
no, it was good. It was good. It was very, very challenging. Anyone who's into running, highly recommend it. It was amazing to get to the top, and yeah, but like, God, it's hard work. Running uphill is tough.
Is it on like a goat track? Like it's not. I imagine it's not.
It's on the road.
Oh, it's on the road. Oh,
yeah, it's on the road. So like you go from.
I was imagining you sort of like scampering up a mountain.
Rock scrambling.
Yeah. I was hoping for a bit of that sort of action.
It would have been easier. It would have been less. It would have been more direct. I reckon.
But no, mate, we've got a bit of a funny old episode today. We're going to run.
Yeah, a little bit of inspiration from an article that I read recently.
Well, tell the people, what are we doing?
So I read this article that was looked at several different timeframes of investment and whether. Basically talk to different people about what they would invest in. And I was like, I think that's a wonderful opportunity to make Luke make some very bold calls on some stocks that he, that he can then reflect on in 2 months, 2 years, and 20 years time.
Just trying to ruin my career as per usual, which is good of you. Lovely stuff. But
no, we'll do that. We'll go through a few different time periods. Talk about. I'll try and talk a little bit about the structural side of things and what's important to consider there for different timeframes, and then maybe some more broad and diverse investment options from my side of things as well. But
so we're going to do it by saying the answer to the question of like, what should I invest in for 2 months, 2 years, or 20 years, which is the 3 periods we're going to cover today, is the same, and it's just a diversified portfolio of assets that are lined up with your risk profile. Yeah, and that's all I do with my money. I know that's what Dill does with his money. That's it. So whilst it's fun to talk about a few stocks and make a few predictions and talk a bit of rubbish,
we really should have prepared and got Ben on here because he actually knows what he's talking about.
Oh, please. I might pretend like the young guy's the brains of the outfit, but.
No, it's good. It's good. He's the young Adonis. But no, like you're right. The answer. I mean, maybe not for 2 months. We'll talk a little bit about that. It really depends on what you're trying to achieve and all those sorts of things. But as always, please don't take any of what we say as financial advice for yourselves. Go out and read about what we're talking about from an investment point of view. And if you haven't done so already and you want to, go and seek financial advice, because it's important that you do things with consideration as to what the long-term outcomes that you are seeking and the impacts that they might have. All right, so 2 months is a very short.
It's literally like Christmas.
It's Christmas, right? So not even. I mean, that's
just Australia Day. So it's the 19th of November today. So 19th of Jan. So let's just call it to Australia Day.
Yeah.
So Dill, what would be your very sensible investment tidbit? If I said to you, Dill, I've got some money I need to invest for the next 2 months.
If you had
What do I
100 grand, right?
What do I do? 100 grand's a good round number.
100 grand, right?
A week's work for you.
A week. not, yeah. In my dreams. No, look, just put your money in a high interest savings account. Don't be silly. Don't take a punt. You know, like realistically, 2 months is not a long time. And if you need that money out again in 2 months, why are you having a conversation about trying to make, you know, quick buck here or there? The reason that that's so important in such a short time period is because the effect of a fall is much more significant to someone who needs $100,000 in 2 months' time than the effect of a gain. So
I'd give the same advice to someone who was like, you know, looking to buy a home for themselves, not as much an investment property.
Absolutely.
You know, like I've got a barrister mate here in Torquay. He shall remain nameless. Lovely bloke. He asked me, a little bit younger than me.
Got any barristers in Torquay, mate?
Well, no one knows. Anyway, so the point is, he's a lovely guy. Very good basketball player. Anyway, he said to me, "Oh, you know, do you mind me asking you, you know, work thing?" And I said, "Yeah, happy to ask." He said, "Oh, I've got some money. Should I save it for a house deposit? Should I just, while I'm saving, invest in the market?" And I sort of said to him, "Oh, look, can't give you personal advice, obviously, asterisk, asterisk, asterisk." But I said, "Look, if you lost money in the markets, your wife's going to hate you. She's going to be really pissed off. If you make money in the market, she's going to be happy, but probably a lot less happy than she would otherwise be pissed off." So I said, as much as it's great to invest in the markets for the long run, and, you know, you should definitely do that maybe in other parts of your finances, when it comes to, you know, saving for a house or, you know, doing emotional things with your money, I'd be very much leaning on the, you know, just keep it sensible, keep it simple, even if that is relatively low return in hindsight. Everyone's best mate is Harry Hindsight. And I coulda, woulda, shoulda. And if I coulda, woulda, shoulda, I wouldn't have to talk to you or anybody else. I'd be in the Bahamas on my yacht. So, at the end of the day, I think that is very sound advice.
Yeah.
Now, in the interest of not being sound, or not giving advice, I will give you 2 stock tips for the next 2 months, and we can all see just how smart I am in 2 months' time. My first stock tip on the ASX companies, right? I'm only going to stick to ASX just for simplicity and because it's in the wheelhouse. Is the Grey Mining. The code's DEG. It's about $1.40 a share. It is a gold mine developing company, you know, and expanding production story. At the moment, it is very strategically located in the Pilbara. It has a permit pending for mining for part of its asset base. There is a lot of skepticism around permits after a permitting disaster on another ASX listed company and this asset called McPhillamys in New South Wales. Market's very skeptical of De Grey getting this permit. I am a lot less skeptical. I think they get that permit in the next 2 months, and that is a significant catalyst for a share price re-rate. In fact, I think it may even be a catalyst for a takeover bid. Now, TBD, we'll see what happens. We think De Grey's worth much more than $1.40 a share, regardless, good business, blah, 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 all the good things. But I do think there is a catalyst inside the next 2 months. So that's tip number 1. Tip number 2 is the broken record. I'll just dust that off. Vulcan Energy Resources, VUL is the code. They will have their financing deal largely sorted out before Christmas in my estimations, and they will certainly have it finalised within the first quarter. So I think that's a pretty good bet. Given that where the market's pricing that at, you know, $6 or $7 a share at the moment, that's pricing in a lot of dilution if we take the MPV of that project as where the share price should be trading, which is how other companies in that sector trade when they're in production. So they're my 2 short-term, 2-month, fun only, no advice stock.
And as is tradition, both of them are mining companies.
Well, we're going to get off the mining, but, you know, when you're asking for 2 months, you want like high impact catalysts.
Yeah,
so
of course.
I immediately went through my portfolio. I was like, okay, what have I got? Catalysts in the next 3 months. Like what's realistic that's going to happen? And I think they're 2 realistic things that could happen in the next 2 months that could add more than, you know, just average market sort of, you know, share price gains, or where I would expect that stock to track in the forward market conditions.
Yeah, for sure. And I think what you were saying before about like specifically, don't go and buy one stock with $100,000 if you need the money in.
Correct. Like,
in
you know,
months.
yeah.
Yeah.
I mean, I've done that stuff, and everyone thinks it's, you know, amazing when you make money and whatever. But yeah, it is. Don't get me wrong. But like, it's really hard to do. It's really hard to do repeatedly. And I think, you know, even now, like, I'm so much happier just investing my money in the small cap and a large cap fund. Like, I love having, you know, 50, 60 stocks. I've got ideas and reasons why I think they're all going to go up for, you know, and catalysts for all of them and valuation support for all of them. I've got much better process. And yeah, you know, when you own 60 things rather than only 3 things, if you get 3 right, you're going to impact your portfolio a lot more than if you own, you know, you get 40 out of 60 right. But I can do 40 out of 60 until I'm 130 years old. You know, whereas 3, if you keep rolling the dice with 3 stocks, chances are you're going to make a mistake. The law of average is going to play out. Even last year in the small cap fund, I'm doing live wire tomorrow, and they asked me about win rate. So we had a 62% win rate last year in the small cap fund. That is unsustainable. I'll tell you right now, in 10 years, I will not have a 62% win rate. So, you know, I hope, well, mate, if I do, I will not be talking to you or anyone else anymore. I'll be well and truly retired.
You'll be talking to me because it'll be my money.
Mate, I won't be managing money anymore. I'll just be managing my own money. I won't need to manage anyone else's anymore. So that's so I think, you know, just to keep that in mind, you know, if you can do the math on, you know, a 3 stock portfolio, recycled. The more you recycle it, the more you roll the dice, the more chance you get it wrong, and eventually the law of numbers comes home to roost.
I think that's a case as well. Like there's a number of funds out there, and like, again, we won't name names, but funds that have like a concentrated version or a sort of best ideas version, and a lot of people will sort of gravitate towards them when they look up historical returns because they will have had one particular really good year and they'll stand out on the basis of that. But that unsustainability of that it rings very true over a longer period and a longer time frame.
You're not going to have sustainable win rates in the 60s and 70s. Like, it's just not going to happen. So if you run a high conviction portfolio, like I'll be willing to make a bet. I could go and look at any 10 to 15 stock portfolio strategy, and I'd be willing to bet rolling 3 or 5 year numbers are pretty average relative to the same sort of strategy, but run out across 20 to 40 or 30 to 50 or even 60 stocks for big global, like more global focused managers. And the simple reason is because they're playing the odds. You're playing nobody has sustainable win rates in the 60s and 70s. So if you're only going to get 50, 55% of your calls right, the question it becomes less about getting the call right and managing the ones that you don't get right and making a lot on the ones that you do get right. And that's actually what the game of funds management is. It's not really a game of, can I pick winners? It's, can I make a lot when I do, and can I lose a little bit when I don't? Because everybody picks winners and losers all the time. If you just do binary, if the rule is, if you're thinking about it on a black and white scale, you know, it's going to be really difficult to do well sustainably because nobody does.
Yeah, for sure. Well, on that basis as well, picking winners, 2 years is a longer time frame, but once again, I think we should caveat with the fact that if you have a specific thing that you want to achieve at the end of that 2 years, investment is, you know, you are taking risk by putting money into the market.
Yeah, this is where I think though that 2 to 5 year, 2 is probably the minimum, but like 2 to 5 years, you can start to think about, you know, particularly if it's a larger sum of money and you need some back and not all of it, and you could start to look at, say, like some combination of like cash, defensive, higher return assets that maybe give you some hedges against things like currency and interest rate potential moves, and then some exposure to equities. Now, we want to keep that liquid. I wouldn't be picking a 10-year lockup private equity fund like I showed you this morning, Dill. And I certainly, you know, probably would steer clear of some of the, you know, stuff that requires you to see it through the cycle to really get the benefit. But there might be some strategic sort of equity exposures we can go after for you, some sort of core defensive income-y focused stuff where significant drawdown opportunities are pretty occasional and unlikely, and then some more guaranteed stuff. So, but chances are in 2 years we'll be able to pull together what you need from some part of it.
Well, this is where, so like my call on this, the 2-year portfolio, for assuming that we're still in accumulation, of course, and we need that money for a period, but 2 years. This is a great example of where a 60-40 portfolio starts. So for people that are listening that don't know, 60-40 basically means we've got 60% of the money that's invested in growth assets. So traditionally stocks, and a very diverse portfolio of stocks at that point. So reducing individual stock risk. And then the other 40, having something that has generally an inverse relationship with those stocks, where both can pay a rate that's above the cash rate over that time period. So
look, this is, you're sort of getting to know our products and your clients are getting to know our products a little bit more, but like some combination here for the bulk of the money of cash that's locked away and gets you a decent interest rate, maybe rolling 12 months TD, something like that. And then defensive income, aggressive income, and absolute return. You're going to get, you could put those portfolios together and achieve something really nice and get someone a pretty decent number, most likely, with good income and not a lot of capital risk on a 2-year horizon.
Yeah, definitely. And like, the benefit there, it doesn't have to swing exactly like that. I mean, we call, like say more defensive income, that's definitely in the defensive side. Aggressive income, we still call that defensive side because it's stable. It does have that inverse relationship, 9 out of 10 times, 95 out of 100 times. There's been very recent examples of where they had a similar relationship. So people are probably going to message us.
I hate 2021. I hate it. Yeah. It's my least favorite year of my career. Anyway.
Yeah, I mean, but that happens once every 100 years, right?
Yeah.
So it's very, very uncommon. But some of those alts type assets, which are still liquid, you can still access them. They're not locked away. Of course, if you're investing in alts, you need to understand what the underlying things are and make sure that you've got liquidity and the ability to withdraw on those assets if and when you need. But you can get above cash rate returns on those things with a fair amount of certainty by comparison to going out and picking individual stocks or picking individual, even picking individual indexes where you may or have a larger chance or more probable chance of experiencing a down year during that 2-year period. So, if one in every 6 years is a down year in markets, if you've got it for 2 years, 1 in 3 chance that you're going to experience a down year. So, is a 1 in 3 chance worth that loss? You're going to experience
and the incremental return you're going to generate over a guaranteed TD. Who knows?
And it's really important as well when people ask themselves this question. I think that don't look at the level of return in isolation. Don't look at, a market might give me 10% or 8% versus nothing. It's the market might give you 10% or 8% versus the guaranteed 5% that you get in a term deposit over that time period.
And that's kind of what
the difference between those two.
It's the same thing with people who are like, oh, you should have paid off my mortgage or invest in the markets. Or draw down on my mortgage, invest in the market. I'm all like, look, you can do whatever you want. Like, I don't care, right? But for me, if I had a mortgage, I'd be just pulling all my money in there because I'm getting 6% guaranteed after tax return. Whereas, like in the market, okay, I might generate a 10, but I've still got to pay tax, and I've still got to take risk, and I might not get 10.
You'd probably come and see me and we'd figure out how to make that mortgage tax deductible.
Know what you're going to debt recycle. But my point is that just on sort of face value, like I just, if you want it, like, it's definitely, for me, 6% risk, risk adjusted is, guaranteed is really hard.
Pretty good. Now, if interest rates go down, that changes, right?
It changes. And it has changed in the past.
Yeah. One thing I would say though is to not be boring, right? So, 60-40 portfolio, really, conservative balance type areas is a good thing to maybe look at in that sense. But in terms of a sector, like smalls, still undervalued, shot the lights out over the last 12 months. I think still going to have a good runway of, Aussie and global, both going to have good runways as sectors. But as always, I reckon this is the 35th time that we've mentioned this on this podcast this year. Don't buy an index for small caps. Doesn't work.
Look, you're not going to hear much argument from me.
I love indexes, and that certain things. It's not an area that you can do that in. So
you can, but you're just not going to do it.
But I think that there is significant valuation discrepancy between the top and the bottom ends of the market. And I think there's massive opportunities within those sectors. I've got a lot of my allocation personally in those parts of the market. And it's what I think is going to do well over the next 2 years. So,
look, I agree. I put more money in our small cap fund just last month and putting more in on the 1st of December. So, I mean,
there's an argument there as well where, maybe you put 70%, you do a 70-30 portfolio, 70% goes into a TD and then go hard into, a fund.
Lots of ways to average out and skin the cat. Lots of ways. Yeah. All right, 2 stocks for 2 years.
2 stocks for 2 years. Boom.
I'm gonna pick two different ones. I'm gonna do so PointsBet, the betting company, may not be everyone's ethical cup of tea, which is fair enough. I'm just here to make a quid, so don't worry about me. Don't mind me over here. But look, I think that's going to get a takeover bid. We've done very well out of that over the last sort of 12 months or so.
Like 60 cents at one point, wasn't it?
It was 60 cents. It's now 96 cents. And yeah, I think we bought it even lower than 60 cents, if I'm not mistaken. But anyway, that's a story for another day. The reason why I think that's going to be good over the next 2 years is because it's got inflecting profitability. And when we're looking at for stocks, they typically fit into 4 categories. We sometimes we buy stuff like asset plays where the sum of the parts is worth more than the whole. Other times we'll buy like underappreciated growth businesses that are growing but just not priced for it. And one of the other areas that we often chase is inflecting profitability. And from my perspective, PointsBet's one of the best stocks in our portfolio and the best stocks on the ASX I can find that has high operating leverage and is still reasonably priced. So I think that stock's going to rip, and if it doesn't rip, it's going to get bid by somebody else. So that's my 2-year stock pick. And my other one, I'm going to pick PEXA. I think that's the property settlement business. We talked a bit about it before. People who have listened to me for a while probably know I like it. I think the UK is going to happen for them. Don't mind this acquisition they're rumoured to be having a look at either, Dye & Durham. I think they're doing all the right things. It's going to take some time, but if you've got a 2 to 5 year horizon, that could be a stock that you look back at that you bought for $13 that might be trading at $30 or $40 a share if they get it right. So I think that would be a good bottom drawer as well. General advice.
We'll talk about that later as well, because PEXA is a fascinating business. We obviously have clients that buy and sell property within our sort of books, and I just think it's one of the best things that's happened to Australian property for a very, very long time. The ability to digitally settle transactions is unbelievable. And I think I might have mentioned when we did this, when we featured PEXA earlier in the year, Tasmania, where I happen to own a house, doesn't have PEXA. I think it's one of 2 places in Australia that doesn't use it. And the contract process here, if any of the Tasmanian councillors are listening, decision makers, just go and talk to someone at PEXA. It is crawl out from whatever rock that you live under.
And they've got 93% market share or something in Australia, 94, something like, if I'm not mistaken. So
yeah, I think it might only be Tassie and the NT because the markets are so small.
Yeah,
that they don't use it. And it's a matter of time, right?
Yeah, it'll happen. But I think the whole UK is like that. The whole UK is Tasmania.
Yeah.
So and they've just done a deal with NatWest, the biggest, mortgage refinancer, and they're putting their 48-hour refinance product through there. And yeah, look, I just think that's on a trajectory that should play out. It might have a few wiggly bits in the middle, and that's really just going to be an opportunity. But I think in sort of 2 years, you're going to be looking back and be like, oh yeah, $13 was good value for PEXA. So that's my 2 year stock pick.
Very good. Well, lastly, 20 years time.
Ooh.
It's
How
a
old
long
will you
one.
be?
We
What,
took the
I'll
jump. We
be,
could have gone 5 or
I'll
10.
be
or
retiring.
like
I'll be retiring. I'll be 58.
58. Oh, I thought you were already 58. Ankles of a 58-year-old.
I do have an ankle left. My left ankle is probably 70.
That's what they say. But like the obvious thing for us as strategic advice, specialists, I guess, is super, right? Tax in super is so much lower than what the average marginal tax rate of a working Australian is. You will simply make more money buying the exact same stuff in super than you would buying it outside super by having it in that environment. And if you don't need the money for 20 years, there is a very, very good chance that on a like-for-like basis, you will outperform fairly significantly by holding it in a superannuation environment. Now, of course, there's restrictions. There's like you can't access it if you really need it, and 20 years is a very long time.
But let's assume you're listening to this podcast, so you're probably making a fair quid.
Yeah.
Let's just assume. Especially if you're a target, prospective client of ours, and we hope you're making enough money that you can you can top up your super enough that you can still got enough left to do what you need to do, even if the shit hits the proverbial fan.
Yeah. Like it's the reality here is that we're not saying that you should put all your money in there, but if you were to say to me, I don't need with 100% confidence this $100,000 for 20 years, and maybe that takes you to age 60 when you can access that money. Superannuation is going to be your best tax-friendly environment to have that money. There are other things that you can do, if you've got different income, trust, you can have investment bonds, you can do these things, but none of them are as simple or as easy or as effectively like.
What about the Caymans?
Well, yeah, but flights to and from the Caymans to do your taxes, that's, 100 grand's probably not enough to set up an account. I think they might want a little bit more than that.
Only winding up.
But like, look, and then within that, 20 years is a long time horizon, right? So six years is a market cycle. You probably see 3 of them over that time. Potentially long-term, high growth, compounding investments is what we want. Even maybe put a degree of gearing in there. Like, if you're just going to buy an index, why not have that with, maybe a geared version or something like that? Not for all of it necessarily, and certainly get advice on when to de-gear as you're leading into retirement and things. But it's a very long time, right? So you've got the time to manage volatility. You've probably got contributions going in alongside that. Mm-hmm. You can't beat it. It's it's a legal tax haven for your investments for that time period.
Pretty good.
Yeah.
Pretty good. The old super.
Super.
I've never understood people's some people's
disconnection.
Yeah, or not. They're anti-super because I think I don't really get it, to be honest.
I think there's a number of different things going on there. There's certainly distrust that people are going to be able to access it from certain groups of people. Putting your money away for a long period of time. I think people because you're not contributing to it. So like in America or other countries, you actually make contributions to your 401k or other superannuation scheme, right? So there's a physical feeling of you putting money into your taking control of your future retirement. Because if you're an employee, which the majority of Australians are, their employers pay the superannuation on their behalf. You never see that as an individual. So money's just accumulating. You sort of get it for free on top of what you get paid. And most people don't include it in what their salary is when they quote it. And so a lot of people just feel like it's not really there. But actually, like it is.
I think that's half the reason you should go get advice.
Like 100%. Like
one of our mutual clients today, early this week. Sorry, I said, one of the benefits of having, advisor, direct visibility, transparency on your super, where you can see all the underlying investments and you can see the decisions that are getting made and the rationale that goes into things. It gives you more emotional connectivity to your money, and you don't feel like you're just getting a 10% haircut on all your money that you earn. It actually becomes a real thing. So
behaviorally, it provides so much more incentive to watch, follow, be involved in those investments,
contribute,
and potentially contribute to them as well. Like people who have transparency on their investments in superannuation tend to put more money into superannuation.
Very good.
Because it feels good.
Very good idea. Very good idea. I wonder who could help you with that. Probably.
I wonder.
All right. Stock pick for 20 years.
20 years stock pick.
Just because I'm trying to piss people off today, and I feel aggrieved for some reason. Woke up on the wrong side of the bed. No, I'm joking. Not really. I'm going to pick New Hope Coal. Thermal and metallurgical coal company in the renewables era is going to be my stock pick for 20 years. I'll give you a sort of rationale why. And why
I think you should.
Is because it's not that I think that some Western countries aren't going to continue to use coal, because I do think they are going to continue. They're going to continue to need baseload power and coal, and it does take a very long time to build nuclear capability and capacity. And on top of that, it also emerging countries are going to probably continue to need both thermal coal and metallurgical coal for steel making. I also think that everybody thinks that coal is going to be dead, and normally everybody's wrong. So, and for that reason, I think it's probably priced too cheap, and the supply-demand dynamics are probably misunderstood. Probably people think that supply is going to continue for longer and demand is going to tail off faster. And normally that sort of macro setup, to me, is a happy hunting ground to go and pick up some alpha. So New Hope's really well managed. Client, friend, Rob Bishop is the CEO, my old boss from Bali. Great people work there. Lots of my old colleagues work there, CFO, et cetera, et cetera. So I know that's going to be really well run for a very long time. They make great capital allocation decisions, really sensible. Know what stuff is worth if they're going to acquire something, know what it's not worth, more importantly, or what's not worth buying. Really good operationally, good assets currently, long mine life at their key assets. And I just think go and read my coal article on Livewire if you want to know my thoughts around why I think Australian thermal coal is actually environmentally friendly. But I think that narrative, it may take 5 or 10 years, but I think that kind of comes out, and we start to see maybe the re-emergence of Australian coal. And I think it is a good 20-year bet at the moment.
Wow, 20 years. I mean, yeah, certainly parts of that.
Look, I'm the biggest fan of renewables as an ex-bloke, but I just think that this is an anomaly. There's an anomaly in the market, and people are not paying attention to the facts. They're paying attention to the narrative, and the narrative is wrong. There's no data to support the narrative. So those sort of setups do not last. They sometimes take a very long time to sort themselves out. But I've got 20 years so to be right on this one. So we'll see you in 2048, 44. Can't even add up.
2048.
Can't even add up. I've lost the plot. I need another coffee.
Give yourself 4 more years just in case.
Must be those coal-powered electricity going in my brain.
How does the coal chat go down at the drum circle on Torquay Beach on a Friday night?
Yeah, I'm a bit more I'm just respectful of other people's views. I don't try and socially, I don't like to sort of run around and
we just broadcast. We broadcast it for everyone to hear.
You know, nobody likes that guy when you try and make a point and then he comes out with 7 points that make you look a knobhead in front of all your mates. So, I just keep my mouth shut as a general comment, and I can respectfully disagree with my checkbook and make money out of it. That's what I'd rather do than talk about it. That's my favourite rapper says. Don't talk about it, be about it. Don't talk about it, be about it. That's it's my motto.
And this is the platform where we get to do both.
Correct.
Look, that is, I think that's a wrap, mate. Look, if anyone wants to invest for 2 months, 2 years, 20 years,
or ideally 20 years. Yeah.
Probably 20 years. Like 2 years, still good. 2 months, I don't reckon we can get a statement of advice back in 2 months at the moment. So,
look, I'll find a way to charge you fees for 2 months. Don't worry about it.
Yeah, that's fine. That's fine. But no, that was good, mate. That was good. I look forward to reviewing in January the De Grey and Vulcan calls, and you know, if we can pump out another 80 episodes or so, talking about points bet and pecs.
Mate, that's a look forward to reviewing in January. I think we've got a few more episodes for the year, and then we might,
and then a couple of Christmas shorts that will be slowly drip fed.
Oh, we've got shorts coming, do we?
Yeah, just a couple over Christmas. They're in the calendar.
Fancy. All right, I'll leave the production crew to that.
Mate, you have a lovely afternoon.
Yeah, you too. I'll chat to you soon.
See you, mate. Bye.
See you guys. Bye.